All right, why is accounting important? Let's get those texts open. Why is accounting important?
Well, someone needs to overlook the finances of the company.
Somebody needs to look over the finances of the company. Let's expand this out a little bit. We're digging in the hole now. Let's expand it out. To earn a profit. To thrive. To spread our wings, spread the umbrella here. Let's go a little bit longer, reach a little wider.
See whether the revenue is greater than its expense.
All right, your textbook's going to tell you accounting is an information and measurement system that identifies, records, and communicates events that are relevant, reliable, and comparable to a business's operations. Key words: it identifies, records, and communicates. Identifying business activities. What do we mean by this?
Activity requires that we select relevant transactions and events.
We identify relevant transactions and events. Okay, remember, what do we want to record and communicate? First, we have to identify what is it of interest. What are we trying to capture? What are we trying to plan, or what are we trying to communicate? To record requires that we keep chronological log of transactions and events that can be measured within currencies. Now here in this class, we'll be talking about the United States currencies, so we'll be talking about dollars. But just know that when we're talking about transacting, again, we're looking at items of interest that we want to communicate and that are measurable using US dollars or using your local adopted currency. All right, who's the users of financial information? Clients, organizations. Let's broaden it down and say external and internal users. All right, who's an external user?
Lenders.
Lenders. These are going to be the individuals who are not directly involved in the business operations, but people who are still going to find an interest in those business operations. Okay, a lender. Why would a lender be a user? Ask yourself, if you were going to loan your neighbor money, what's the one item you probably want to be certain of first?
You're paid back.
You're going to be paid back. Okay, when your bank loans you money, they've done measurements and they've analyzed data to ensure or at least predict that you're going to be able to pay back. What about investors?
Return on investment.
Return on investment. Okay, again, if you're holding investments in any type of account, retirement account, 401k, 403bs, IRAs, hopefully when you selected those investments or whomever you worked with to select those investments, they could be a user. They might have analyzed some accounting records in order to determine if that was a good fit. Okay, internal users. Who are we referring to?
Those ones are directly affected.
CEO, CFO.
Well, rather than say directly affected, let's say those that are directly involved with the business operations. Okay, the managers. And there's a discipline of accounting we even call managerial accounting that's designed specifically for internal users. Okay, so the internal users are those that are managers in the company that are responsible for the day-to-day operations, both large and small, these even including strategic planning. All right, if you look over in your text on page, might be on page 5 is what it's showing up here. You're going to see external users can include lenders, shareholders, governments, consumer groups, external auditors, and customers. And then we see the internal users. Now, a point that I want to make here is that technology, when we look at accounting and you think of accounting, you know, every now and then you are going to see folks who are, okay, I ask this, who still uses the paper check register? You know, that comes in the back of the checkbooks?
Oh, don't you balance in your checkbook?
Yeah. Good for you. The one tells me that you are balancing and reconciling your checkbook. You just don't see that many people. It's a decline of folks that are used, probably a decline of folks even using checks, but it's a decline of folks who are using checkbook registers. Okay, now in accounting, we're going to find the same thing. You know, accounting has come a long way with the use of technology, you know, that we're finding technology empowers and drives a lot of this communication. You know, it has to be data has to be input, but technology will do a lot of the calculations. Technology will do a lot of the report printing and do a lot of the communication. Despite how good that technology is, though, and despite how far technology has come, what's a critical factor here? I want to make a point that I could print out right now all of the financial reports that I analyze on a day-to-day basis, and I could pass them out to you. Chances are you could make sense out of some portions of them. But I would hope after years of practice, I can drive more meaning out of them. Okay, so even though technology is doing all this tool for us, it's important that we build some accounting knowledge here so that when we are looking at these reports or we're having these conversations, we know what's going on. We know what we're seeing in print. We know what's coming out of the mouths of our coworkers. And we know what topics are being discussed. All right, another point I want to make. Managers. Okay, we call these the internal users. Now, they are the ones who, again, set the financial goals of the company. They set the strategic plans. You think about, why is a company in business? What's the primary objective of a company?
Make money.
Ladies, what's the primary objective of a company?
To earn money.
You don't make money. It's illegal to make
Make
money.
money if you work for the government.
We earn money.
The Treasury
The
Department.
Treasury Department, the Mint, will make money. But we earn money. And actually, not only do we earn money, the chief objective is that we earn a profit. Now, in order to earn a profit, why does a company why is it mandatory that we earn a profit? Again, that tells us, are we achieving our goals? If we're not earning a profit and we're losing a profit, we're probably not going to continue that pursuit very long. We need to earn a profit to stay in business. We need to earn a profit to keep folks employed. We need to earn a profit to achieve our other objectives. Well, again, communicating these accounting reports, this is where this data is going to come from. So when they're setting the budgets and they're setting the plans, they're analyzing these financial statements and other financial reports and key ratios, items that an accountant put in there. Okay, so think about that. Bad data goes in. Bad data is going to be pushed out. Nobody likes bad data. All right. We talked about the opportunities in accounting. Again, I mentioned managerial accounting was within the insiders, so internal users. What's some other disciplines in accounting? Taxes, definitely taxation. Preparation, planning, regulatory environments, all going to be fields within taxation. managerial, cost accounting, budgeting, internal auditing, general accounting, bookkeeping, all of those are going to be on the managerial side. Financial accounting. Okay, here, preparation, analysis, auditing, regulatory, consulting, planning. As a practitioner, this is where I would find myself. Finally, look over here, accounting related. Who would think that when we talk about accounting, we could talk about FBI investigators, something called forensic accounting, litigation support, traders and analysts. As technology has evolved and as businesses have become have been forced to adopt technology or increasingly adopt technology, and what threats exist out there. Okay, it's easier to move money. Go all the way back and think about 9/11. Think of how much dirty money is probably exchanged throughout our economy through the use of digital means. You know, if I want to make a bank deposit, I'm not required to walk into a bank branch anymore. Okay, now it was a lot of forensic accounting that went back after 9/11 that was able to trace the root of all of the funding and the network that was used and how it all went out in cyberspace. It was a forensic accountant who went back and was able to trace that down through some legal folks, through some law enforcement individuals as well. Okay, a lot of white collar crimes that you see on the news. Okay, your Bernie Madoffs of the world. It was some forensic accounting that went back there. Even though these records might be destroyed, we can build these records back and see how you're getting at these numbers. These are going to be items that, you know, I wouldn't have, when I was a student, we didn't talk about these, but as times have changed, and you can bet as technology is only growing, it was said here an 8-year-old MacBook is obsolete now. And if you're using technology, yes, you know that it's changing. All right, let's talk about ethics. When I say ethics, what comes to mind?
Right and wrong.
Right and wrong. What else?
I can't think of any other terms.
And the goal of accounting is to provide useful information for decisions. For information to be useful, it must first be trusted. And in our news media right now, we're hearing a lot about fake news. All right, fake news. But trust me, you open a Google browser and you start typing stuff in, and you're going to hear about the little elephant boy who was just discovered on some remote planet to the next way to make $1 million. I don't know. You can find anything on the internet. Hopefully, though, you know what to believe and what not to believe. Hopefully, we have sources in which we go to because we find them to be reliable. We find them to be trusted. By the way, in this class, when you're citing a reference, please do not use Wikipedia when you're referencing your work. All right, again, Wikipedia
Can be edited.
can be edited. Users can go in and add that. Users can go in, registered users can go in and edit that work. So please refrain from using Wikipedia. But when we talk about ethics, when we get these reports, or when you're making an investment decision, let's focus, we can all be an external user. Okay, let's just say we're all investors. Okay, if you were getting ready to make an investment in Apple, okay, one thing that you might go in and look at is Apple's, or you might look at their financial statements. Now, if you go to the Securities and Exchange Commission and you download filed statements, I'm going to suggest that you can trust the Securities and Exchange Commission. Okay, and again, because that's trusted, a lot of decisions, you make a financial decision based on that. You make the choice to either buy or we'll say to invest or not to invest in Apple based on what you're seeing. So again, when we talk about ethics, we talk more about right or wrong. We'll talk about trust. All right, now, how do we ensure trust? Who's ever seen this fraud triangle? Do you see it in your text?
I see it in the text, but I haven't seen it.
All right, what do we got going on here? You don't have the text right now. Let's talk about, everybody knows what a triangle looks like. 3 sides.
Opportunity, rationalization, and financial pressure.
All right. What's going on here? Financial pressure. All right, we're going to say this was adopted by criminologists. They assert that 3 factors must exist before a person can commit fraud. All right, the opportunity, the rationalization, and the financial pressure. What do we talk about financial opportunity?
So a person sees a way to make a financial gain with little risk to getting in trouble.
A person sees a way to behave unethically, we'll say, without getting into trouble. So again, opportunity must exist. Rationalization.
They fail to see the criminal nature of the fraud, or they can justify their actions.
They fail to see the criminal, they fail to see what they're doing wrong. They justify and they rationalize. This is okay. It's not too bad. Or at least opportunity comes first and they're going to rationalize. And what's one reason they might use for rationalization?
Is that the company like Enron doing all of that stuff that they were doing?
I'm going to say, could we use an example of Enron? Absolutely.
Okay.
I don't even know what Enron is.
What is Enron?
One of them big companies that was doing, I don't even know what company it was, I just remember hearing it in the news.
All right, if you want a good reading, I'll give you a quick synopsis here, but if you want to have some good reading over this week, go back and just look at the rise and fall of Enron. All right, we're going to go back to the 2008 financial crisis, and Enron was an energy trading company based down in Texas. And there were the CEO and the CFO became of national fame during that time period. Enron just continually kept rising in value. They just kept seeing, they were producing reports, but they were rising. Wall Street couldn't believe. Investors started thinking, how can this company keep earning these keep producing these high financial results? All right, what after an investigation, after some accountants come in there, what they find is Enron was taking all their good stuff and putting it under Enron. Taking all their bad stuff and creating these false entities out here, and they were pushing their losses off their books. We're going to talk about some legislation that came out of, we'll talk about Sarbanes-Oxley here in a minute, because what happened is when they were found guilty, when the CEO and the CFO were found guilty in front of our Senate, their claim of defense was, I didn't know about it. They actually claimed they were too high up the corporate ladder, that fell beneath them. As the CEO, I don't know, I don't produce these reports. And even the CFO, as the CFO, people under me produce these reports. I'm focused on more strategic planning. I'm looking at the bigger picture. Both of them claim that they didn't get down into the narrow details. Now, once that was exposed, you know, we had some folks get in trouble. We had some legislation come out of it. And Enron, we're talking about it in past tense right now. So yes, Enron, a good little company. And I'll Google, look at somebody called Kenneth Lay.
Kenneth who?
Lay.
Lay.
All right, it's going to be important to recognize that all three of these factors have to exist. In the absence of one factor, if I remove one of these, it's unlikely that we can have fraud exist. If I remove the opportunity, you might be able to rationalize and see the gain that you can get, but if I don't present an opportunity for you, you can't get this ball started.
Now, aren't there like some odd cases where there's like narcissists that do this just to prove that they can kind of thing that kind of defeat this fraud triangle? I mean,
There are narcissists
for
that say-
everyday Joe Schmo like you and I, this is what has to happen for us to commit some kind of fraud. Whereas like a narcissist is just gonna do it just to prove they can do it.
Let's use the narcissist. They still first have to have an opportunity. They're still going to rationalize, even if it is, I'm going to rationalize, I have this opportunity, and I'm going to rationalize, I'm going to do it just to prove this model wrong. And then there's going to be something to gain from them down here. What is that to gain? Why would they want to prove this wrong? They're probably going to be on the Dr. Phil show. They're going to be speaking to where? Cashing in stock. They're going to be doing something. They're doing that to gain something. Now, it might not be as pretty as the Enron case, or it might not be as illustrative as the Enron case, but these three factors are still going to have to exist. And usually, if we can separate, you know, this is what management, when you think of some of the operations you may have in your workplace, I'm going to guess no one in here signs their own paycheck. Okay, there's probably a reason for that. Especially if you're in HR and you're tracking your own time, you probably not signing your paycheck. All right, so now let's talk about how do we get everything, how do we ensure that everything is trusted and we know that it to be good data. We're not talking fake news. Who's going to help us ensure good data? What do we have here in the United States?
Government.
Government, specifically though, what within government? What within accounting?
ACC.
How do we govern ourselves in the accounting world? What's GAAP? Generally accepted accounting principles. What else you know? Come on, Ed, you even have a big box right there in the.
Yeah, it says, GAAP aims to make information relevant, reliable, comparable.
We want to make sure this is good data. We want to make sure that if you see that a report or a financial an accounting record has been produced and it has followed GAAP, the idea is that this gives you some trusted knowledge that that report is therefore reliable. More importantly, if companies here in the United States are required to adhere to GAAP principles, does it not make the data comparable? Meaning, if I wanted to take the income statement of, all right, company Everyone heard of Snap? Social media app,
Snapchat?
Snapchat.
Snapchat, oh, yeah.
See, and I know it just from the investment side of it. So Snap is the company name. Now, they just had an IPO last week. So if I'm sitting here and I want to think, what is the best social media company for me to invest in? Okay, right now I can pull up Facebook, I can pull up Twitter, I can pull up Snap,
Instagram.
and, well, are they publicly traded?
Oh.
Okay. LinkedIn got bought by Microsoft. But I can pull up those three companies. Knowing that and I pull up their income statement. I know that each one of those income statements have been prepared following GAAP. So therefore, whatever Facebook calls net income and Snap calls net income, I know that they followed the same rules and regulations to get down to that number. Facebook bought Instagram. There we go. Facebook tried to buy Snap. But so we do know that whatever they're calling net income, each had to follow the same rules in order to get down there. So again, knowing those steps that would be involved, I can easily compare those two companies based on what I understand net income to be. All right, now what's going to happen when we go outside the United States?
International Accounting Standards.
International Accounting Standards Board. And what else?
Financial reporting standards.
All right. Difference, the International Financial Reporting Standards. All right, so who oversees GAAP?
SEC.
Not the SEC.
FASB.
FASB. So the FASB stands for
Financial Accounting Standards Board.
Financial Accounting Standards Board, oversees GAAP. Now, who oversees the International Financial Reporting Standard?
Board.
ISB. ISB.
All right, your book's going to call it the IASB. So the IASB. Now, think about your own operations. Who works for a global firm? Who's impacted by global trade? Countries. What kind of cars you drive in?
Ford truck.
Toyota.
Nissan.
Ford, Toyota, Nissan, Subaru. We're going around the world. Think everything from the gasoline that you pumped in that car. Think about your source of energy. Think about the clothes that you wear. Think about the food that you eat. The water you drink, these laptops, where they're made. All right, we are all impacted by global trade. Global economies are closely intertwined. And we see increasingly that global trade. When you're evaluating companies based in the United States, and we'll pick on Asia and Europe. Okay, so if I'm looking at a company here in the United States that is producing reports based on GAAP, and I'm trying to compare them to, let's say, Ford Motor and Toyota. So Toyota producing and following, and we're going to talk about following an international standards, whereas Ford's going to be in GAAP. we can see as more investors, and we here in the United States, we have access to both of these companies as far as making investments. We can both be external users to these two entities. Now, again, remember, when we talked about ethics, one objective was that we have good data that is reliable, trusted, and comparable. Now, we know that there's going to be differences between these two standards. I can tell you that right now, if you look in your text, differences between GAAP and the international board are decreasing as these two entities continue to try to work out a marriage that will bring these two standards under one umbrella. Now, for some time, I've been setting up here in class and I've been making that same statement. I like to think that one day we will realize a true universal statement, at least from those that are adhering to these standards already. Because what that allows us, when you're comparing those international entities to our own domestic ones, we find that they're not as easily comparable. So again, we lose one of our objectives for good accounting data. All right, let's flip over to principles and accounting assumptions. We're going to get a little more detail under GAAP. Now again, let's look at the accounting principles. What's the cost principle?
Measurement principle.
Well, it can also be called a measurement principle, but what's it?
Accounting information based on actual cost.
Accounting information based on actual cost. What's the revenue recognition principle?
The principle prescribing that revenue is recognized when earned.
The principle saying that revenues are recognized when they are earned. Note, the key word being earned, not when it's received. What's the expense recognition? Just like the revenue recognition says that we are going to recognize revenues when they are earned, the expense recognition is going to say we're going to recognize expenses when.
The revenue reported.
To prepare the revenue reporting. When did we use the resources? When did we expend the resources in order to earn the revenue that we are reporting? So expenses are recognized as they are expensed. Revenues are recognized when they are earned. Again, not when they are received. All right, what's some, well, we got one more here. What's this full disclosure statement?
Prescribes that a company report the details behind financial statements that would impact users' decisions. Those disclosures are often in footnotes to the statements.
All right, the full disclosure principle is a company is required to report the details behind the financial statements. Usually we find this as a footnote down at the bottom of the report. But again, if there is anything that would have us, anything that we need to specially recognize, something that we might think of this as an explanation to tell us something is maybe extraordinary. Okay, I'll give a good example. If a company has to settle a litigation and they have to pay off a lot of money for that litigation, they have a large one-time expense. They might include a footnote down there that says, this was done to pay off such and such legal expense. Companies have big write-offs of losses. If you sell a business or you bought a business, you would want to have a footnote there. What are some accounting assumptions?
Going concern.
The going concern reflects the assumption that the business will continue operating instead of being bought or sold. So when I look at accounting reports, I'm going under the assumption, and again, this textbook speaks a lot about Apple and uses Apple as an example, so I'll try to draw from Apple, and I will also draw from companies in the local markets here. But when I look at Apple's 2016 financial data, and again, I'm coming at it as an external user, and I'm deciding if I want to make an investment in Apple, I'm going to have the going assumption that Apple is going to continue to be in business in 2017, in 2018. So there is that going assumption. Time period assumptions. All right, presumes that the life of a company can be divided into time periods, such as months and quarters. Often you will find these published accounting records as being written on a quarterly basis or an annual basis. Well, when I see this data, I'm going to have the time period assumption that, again, I'm assuming you're drawing. If I see fourth quarter 2016, I know we're talking about those final 3 months in 2016. Monetary units, express transactions and events in monetary or monetary units. So when I look at an income statement, which is telling me revenues and expenses, I'm going to know that we are referring to a monetary unit. And if you're reporting under GAAP here in the United States, I'm going to assume this is U.S. dominated dollars. Business entity assumption. All right, a business is accounted for separately from other business entities, including its owner. Okay, one of the characteristics we're going to move in here of a corporation is that it's its own standalone entity. So if Apple is up here talking about Apple, we're not referring to any of the owners of Apple. If Ford Motor is talking about Ford Motor operations, we're not talking about Bill Ford or Mark Fields. Yeah, they might hold a significant portion of money in Ford Motor, but again, when Ford Motor produces their results, those are completely separate from these two individuals. All right, a business entity can take on one of three legal forms, and what do we have? The sole proprietorship. I'll let SP. What's a sole proprietorship?
It's owned by one person.
Owned by one person. Is the business taxed? No. Do you have limited liability? No. Is there a business entity?
Yes.
Yeah, you might not know it, but there is. Is there a legal entity?
No.
No. Is there unlimited life?
No.
No. I'll give you real quick. You get your list, springtime's in the air, grass is growing. You get your lawnmower out. You go out here and you decide that you're going to start cutting grass. You go to your neighbors and you knock on the door. And I say, hey, my name's Charlie and I'd like to cut your grass for $10.
Come on over.
Okay. Person, so there's an offer. I just offered to do something. If you accept it, we have offer and acceptance. If you accept and say, yes, mow my grass, here's $10. Guess what? I might not think about it, but I'm in business. I'm a sole proprietor. That $10 that I earned, I'm responsible for reporting that on my individual tax return and paying income taxes on it. What happens if while cutting your grass, I hit a rock and throw it through your window?
You're responsible for it.
You're probably not gonna be happy, and you're probably gonna demand that I settle and pay for it. But what happens if I tell you, you're my first client? I only have $10.
Doesn't matter.
We're probably going to court. Okay, and my personal assets at this point become subject to the court's decision. All right, what's another one?
Partnership.
Partnerships.
Two or more.
2 or more sole proprietors. All right. No, there's not one owner. Business, how are they taxed? The business is not taxed. Again, Chelsea and I now are going in business together. You do the grass cutting, I'll run the weed eater. So now we're gonna go in there, we're using $10. We'll raise our fee now that there's 2 of us. So now we're gonna say 20. And we have an agreement called a partnership agreement. She and I prepared, and we formally, if it's not written, we verbally talked about hopefully how we're gonna split money. Let's say we're equal partners. I'm gonna give you 51%. All right, so she gets 51% of the company. That $10 that we earn, she's gonna get 51% of it. I'm getting 49% of it. And we're gonna report it on our individual tax returns as such. Now again, we throw a rock through the window. And the bill comes. She's responsible for 51%, I'm responsible for the 49%. So there is no limited liability. Is there a universal or an unlimited life? No, just like in the sole proprietor. If I'm the sole proprietor and I die, Charlie's grass cutting dies with me. I don't want to wish anything bad on you, but we and I go on to the promised land. All right, Charlie and Chelsea's grass cutting, it's no longer in business. It goes to the promised land with us. All right, what's the last one?
Corporation.
Corporations. And I'm going to be talking about a C corp here. So a corporation, one owner allowed. Yes, you can have a lot of owners. Is the business taxed? Yes, in this case, we're now incorporated. So CNC comes up to cut your grass. CNC gets that $10. CNC is going to file that $10 on their tax return, and they are going to pay taxes. Now, as employees of CNC, we're going to earn a paycheck. And then that paycheck is what we report on our taxes. In this case, we have what's called double taxation. Income's only taxed once here, only taxed once here. We're double taxed here. Now, what happens? We throw the rock through the window. What kind of liability protection we have?
It's on the corporation and not on the individual.
It's in the corporation and it's separate from the individuals. So you can technically file that charge against the corporation up to the point that you would bankrupt the organization. But now we're assuming here no fraud or no deceit or no intentional crime was applied. We're going to be separate. We're going to be shielded. We're going to have a layer of protection there.
So therefore, the person could not sue us just because we work for the corporation, right?
They wouldn't sue us, they would sue the corporation. Now, unlimited life. Yes. If CNC both go to that promised land, as employees, if we go on, CNC is going to continue in business. Okay, until a record is prepared and there's some articles to dissolve it. So it has to have that extra step of actually dissolving that, but it's going to assume that this lives forever. All right, somebody tell me about the Sarbanes-Oxley Act.
There was an act passed in 2002 by U.S. Congress to protect investors from fraud.
An act passed in 2002 To curb the financial abuses at companies that issue publicly traded stocks, SOX requires that these public companies apply both accounting oversight and stringent internal controls. The desired results include more transparency, accountability, and truthfulness in reporting transactions. All right, let's look at these examples in the book. We talked about Enron early on. All right, inflated income, hid debt, and bribed officials. WorldCom, and all of this occurred right around the same time. What WorldCom do?
Understated expenses to inflate income and hid their debt.
Hid their debt, underinflated income. Fannie Mae, Adelphia, AOL, Xerox, Bristol Myers, you see all these companies there. But I'm really going to focus, I mean, if you want to really look at the legal abuse, look at your Enron, your WorldCom, and your Adelphia. Okay, now, again, what did I say? Enron officials. What did they cry out in front of the Senate?
They didn't know what it was.
We didn't know what we were doing. We didn't know that was going on. That happened so many floors below us. Ignorance is no excuse to the law. Well, we have to have that law written. This is why we have it. You know, the argument was, you are the CEO and the CFO. You are the individuals that the public looks to. You're the one testifying. You're the one presenting these results. You're the one on the conference calls. You're the one on Bloomberg and MSNBC. Okay, when you're the one speaking, you're the face to these numbers. You know, would you get up and inflate a number? Would you come up and tell a number that you were not comfortable with? Or would you tell a number that you were not educated on? Chances are no, hopefully not. But because that trust is placed in you. So now SOX requires the CEO and the CFO to put their signatures on these financial reports. And now they can be held liable for the data. If there's found fraud on this, they can be, in their capacities, be found liable to data that was there. Dodd-Frank. I want you to pay attention to this right now, because right now, our current administration, okay, Dodd-Frank, what you find is this is people's, these are the last names of some Congress folks who helped push these bills through. But Dodd-Frank, what's this?
Act to promote accountability and transparency in the financial system in the notion of too big to fail, protect the taxpayer by ending bailouts, and to protect consumers from abusive financial services.
All right, that's a whole lot of work there.
Sure.
Let's see if you can narrow that down.
Transparency.
Transparency. Okay, now the reason I said you want to pay attention to this, Dodd-Frank was designed to promote accountability and transparency, put it into the notion of too big to fail, protect the taxpayer. Who heard of the phrase too big to fail? Okay, again, we're coming out of the 08-09 financial crisis. Well, I'm going to go back and say this is a little bit after Enron, when we started seeing the too big to fail terms. We think of Bear Stearns, think of Lehman Brothers, think of Freddie Mae and Fannie Mac, think of Countrywide Mortgage, Bank of America. Think of these banks that had to require government bailouts and government assistance. GM.
I wish I knew any of these.
Do what?
I just wish I knew any of these. I was like in 8th grade, I didn't know anything about
Oh, wow.
Yeah, so
this is the time where y'all, like, you're definitely lucky you've seen it. I have no idea about any of these.
yeah, you go back and look at the 2000, I mean, read about the 2008 crisis. I mean, we're talking about,
Puberty for me?
well, I'm not going to talk about puberty, but I'm going to talk about You know, we have in economics, we're going to talk about, I can talk about depressions. Okay, and I would go back to the 1929 to 1933 34 years. Less than a depression, we have a recession. Okay, in our 2008 to 9, we were a whole lot worse off than a recession. We were not quite as up there as a depression. I can tell you we were one hiccup away of going into a depression. And in my personal opinion, we did not go into a depression because certain decisions were made. If I go back and compare that time period to the United States Depression during the early 20th century, one thing that I noticed is Congress was, one, there were not laws that enabled Congress to act the way we did in 2008. And two, Congress was very delayed in their actions, history has shown us. So now I can say good or bad, decisions were made that I think kept us and steered us out. Now, I'm not going to say we didn't please everyone. I agree. I'm the first to agree there were companies too big to fail. I mean, there was one time Bank of America was controlling 10% of all currencies and all dollars transacted across the United States. And can you think about it, if Bank of America would have failed right after they bought Countrywide Mortgage and Merrill Lynch, think of the impact that would have had on, I mean, that would have affected a lot of folks. Merrill Lynch had controlled, they were the largest asset manager. Countrywide was your largest mortgage holder. Same thing with Freddie Mae and Fannie Mae. Now we're getting into government agencies who required. So now the argument behind repealing this right now, I'll give you a quick backdrop on this. You know, put an end to the notion of too big to fail and protected the taxpayers by ending bailouts. Okay, one thing it did to the banks is it required them to increase the amount of capital that they are holding. How much cash are you holding, or how much liquid assets are you holding? So if there was a significant negative impact on your accounting operations, could you withstand another big hit like that? Okay, now these banks have to adhere to what's called a stress test. They have to prove to regulators now that, hey, yes, I could withstand a 10% drop in our accounting. Now the argument now is that that pressure to too big to prove you're not too big to fail, when no one wants to be labeled that. Okay, you can find some good research of where American Express even fought to say they were not too big to fail. Some insurance companies shed operations, MetLife, so that they would not become too big to fail. I mean, they sold off companies to fall below that minimum. Now, as those capital requirements through the years, they were strengthened and they had to hold more and more capital reserves. And in case you didn't know, your bank does not make money by setting and holding your money on deposit. Your bank makes money when they loan that money out. Okay, now, how much capital they're having to hold. We right now, I would argue, have probably the tightest financial regulations under Dodd-Frank. We have among the tightest financial regulations in the global economy. Now, the banking industry has cried that we are running afoul and it's putting pressure on. It's hard for them to compete. So one thing that the Trump administration, and again, I'm not advocating any president here, but right now we have this being under review. Coming out of the pipeline, I think you'll see proposals to either close it or shut it down, or at least loosen some of the requirements. And again, anything that I said there is my personal opinion. And I really didn't give you an opinion, but. All right, let's take a quick break. All right, moving on to the transactional side. Let's flip over to UC, Transactional Analysis. And somebody tell me, what is that fundamental accounting equation?
Liabilities.
Liabilities, but let's start it off.
Assets equals.
Assets equal
Liabilities.
liabilities plus
Equity.
owner's equity or equity. Assets. All right, so we'll call it equity. When you are submitting a problem or you are reviewing data, specifically you're reviewing the balance sheet, and if you notice that your assets do not equal liabilities plus equity, what do you think you just discovered? You did something wrong. There's an error somewhere in the data. All right, so what do we talk about? Equity. How can we expand this? What are we talking about? Remember, equity are going to be those items that the owners in the entity have a claim against.
Like land.
Well, specifically, contributed capital. So somewhere at some point, an entrepreneur put up capital to start that company. Today, if we're talking publicly traded companies and you're a shareholder in that, you are contributing capital. And what else?
Retained earnings.
Retained earnings. Retained earnings are going to be those items, money that is left over after all of our legal and liability obligations have been met. And we have net income. If we do have net income, we must decide what do we do with that net income. Item one is we can return that back to shareholders. If you ever get a dividend in an investment you own, that is earnings that's being returned to you. But if they are not being returned to you and they are kept within the company, we call that retained earnings. All right, so real quick, assets equal liabilities plus owner's equity. All right, so let's look here. Now, Lana invests $30,000 to start a company. What accounts are we talking about? We define this before we go into that. Somebody tell me what's a liability. Creditors claim on assets. All right, so creditors claim on assets, and what's an asset?
Resources the company owns.
Resources that the company owns and
Expected yield.
has an intended use to earn a profit. So it's assets that you own, it's everything that you own. It's the cash, it's the land, it's the buildings, it's the equipment.
Value.
All of those items are being used in order for you to pursue your accounting objective. That primary one being to earn a profit. Liabilities are going to be the creditor's claim on these assets. And the owner's equity is going to be comprised of contributed capital and retained earnings. All right, so now, Lana invests $30,000 to start a company. What accounts are we going to have affected? Excuse me?
Equity.
Equity. And what? So let's look at this. So we said 30,000. So if we want to put 30,000 over here, what do we know?
Their assets equal 30,000.
Well, assets or liabilities have to equal 30,000 or a combination of these two. But when I say $30,000, what am I referring to?
Capital?
It is capital, but what does it start out as? Cash.
Oh.
Okay, so cash being an asset, we would balance this equation like this. So remember, when we're talking about assets, I'm going to be talking about cash. We'll give you three broad categories to get started: cash, supplies, and equipment. I always say, look for keywords too. If you see the term receivables, chances are you'll be referring to an asset. Accounts receivable, I've already performed the work, I've sent the invoice out, and I'm waiting to be paid. All right, now when you see the word payable, usually referring to liabilities. And I'll give you two big categories right now: accounts payable and notes payable. Accounts payable, I've bought something or I've used some service and I have been invoiced, and now I need to write a check. All right, notes payable, I owe someone else money. Somebody's lent me money.
Like a card.
When you think of owner's equity, when you put up this $30,000, we're referring to corporations here, so you're going to get stock. So when I'm talking about contributed capital, I'm going to be talking about stock in the company. All right, so specifically, we got 30,000 in cash, and then 30,000 here in stock. All right, now let's try another one. Company purchases $2,500 in supplies. How did I get those supplies?
By spending money.
By spending money. All right, we'll refer to money as cash.
Cash.
So 2,500 in cash. And what else did I get?
You got the product, right?
I got the product. Okay, so
That's receivable.
now remember,
That's a liability.
no. Think about.
Equity.
But now if I paid for this in cash, right?
Mhm.
So I would have decreased my cash position of $2,500. But what did I get? I got supplies. Supplies are an asset. So my supplies also gained. Does my equation still balance? Yes, I'd be left with 0 equals 0. If this was my only transaction that I had, these two would cancel each other out. All right, now let's say we purchase equipment for $2,600. Well, let's not, I don't know equipment, let's say 26,000.
That's cash.
Cash of 26,000.
And then the assets.
And then my same example. I'm now going to have a $26,000 asset. All right, now let's look at some of the other side. Let's look at some that involve revenues and expenses. All right, what kind of business do we want? All right, so then we're gonna provide consulting services to a customer for $4,200. And the customer pays us right away in cash. Okay, cash is an asset. So 4,200.
Equity?
For equity. Specifically, this is going to be revenue incurred. And remember, if that revenue is not claimed against the creditor, it's entitled to the owners. It's the equity portion. Paid rent of $1,000 and $700 to employees.
Liability?
Okay, so first, what did we do?
Paid $1,000.
So we paid $1,000 and we paid $700. Now out here, if we don't, what's the opposite of a revenue? An expense. So revenues increase owner's equity, expenses decrease owner's equity. Everyone understand when I'm putting that in parentheses, I'm referring to negatives or decreasing. All right, provides consulting services of $1,600 and rents facilities for $300 to a customer on credit. All right, so let's look at the first one. Provided consulting services of $1,600.
That's revenue.
Okay,
Well,
so what's the first account that's going to be affected?
the assets, right?
The assets, so 1,600.
And then there's an expense of the rent.
But now here's the key. Did I receive this? Here we were talking about cash, and here we were talking about cash. So remember I said we received this on credit. So we sold it on credit. We didn't collect.
So technically, wouldn't that be a liability?
Well, technically, we've already provided the services. We've earned it. Remember how
Receivable.
it's accounts receivable.
Supposed to be an asset.
We've already provided the services for it. We are entitled to it. We've just not collected yet. Remember that revenue recognition rule. We've already provided the services to recognize these revenues. So $1,600, and we will call that accounts receivable.
So what do you do with the amount in which you paid?
What would we do with the amount that we pulled out?
I mean, technically, that's an expense, right? Because rent is,
We wouldn't be an expense yet because I've not paid it out. Remember, this is the owner's claim. This is going to represent the owner's claim on these. Well, the owner's not going to be able to claim this because someone else already has a legal claim on it. So we would decrease revenues by $1,600. When you're performing these, I would say the first step I would always look at, you need to go back and familiarize yourself in the text with the terms that I'm throwing out here of assets and receivables and payables. I said again, looking at keywords, receivables, we know we're going to be on the asset side. Payables, we're going to be on the right side of the equation. We're going to be over on the liability side. But just know, whenever you push this out, this equation is gonna have to equal. Your basic accounting equation that you will follow, you know, this is the golden rule. We're gonna call it the accounting profession. And then what I've done here is I start to expand it. So what do I mean when I talk about owner's equity? Okay, you have the owner's claim or items that can't be claimed. All right, now client in transaction pays $1,900, or let's say $1,600. Yeah, $1,600 for consulting services. Okay, so we just paid. So we just got paid, so $1,600 in cash. And now what?
This for services?
Should we still be expecting another $1,600 to be paid?
No.
Remember, if I just left it, if I was just looking at the accounting equation there and I see a balance of $1,600 of accounts receivable, I'm still going to assume someone owes me $1,600. Again, my equation will still balance. All right. Let's flip over, and here's where we'll be. Let's talk about these financial statements. What are our 4 basic financial statements?
Income statement, statement of retained earnings, balance sheet, statement of cash.
All right, so we're going to talk about first. Let that dry. We're talking about the income statement. What is the income statement?
Company's revenues and expenses, along with resulting net income or loss over a period of time due to earning activity.
All right, so the income statement describes a company's revenue and expenses, along with the resulting net income or loss over a period of time. So we'll put out here resulting in net income or loss. Your next one, the statement of retained earnings. And I'll put over here a period of time.
Explain changes in equity from net income or loss.
All right, the statement of retained earnings. Explain changes in equity from net income or loss and from any dividends. So how can we abbreviate? Explains change to equity. Over a period of time. Your next one, balance sheet. What's the balance sheet?
Company's financial position.
At a specific period of time.
All right. Your balance statement is going to describe a company's financial decision. It's going to tell us the assets, the liabilities. Those are your 3 sections. the assets, the liabilities, and the owner's equity. Over? No. At a specific period of time. This is something that's unique right here to the balance sheet. And your fourth is going to be the statement of cash flows. And what are the statement of cash flows?
Identifies cash in and cash out over a period of time.
Cash in or cash out over a period of time. How does cash enter or leave a company?
Receipts and payments.
Receipts and payments. All right, I'm going to tell you that all cash, the statement of cash flows, its major sections are going to include cash entering or leaving as a result of financing, investing. Or does the book tell you the third one? Excuse me?
Operating.
Operating. All right, so all cash enters or leaves a company based off of financing, investing, or operating activities. All right, and let's look real quick.
Right. Probably what I'll end up wanting to do.
Okay, so here what I have up on the board is Apple's income statement. And we'll note that we said an income statement, revenue minus expenses. So up at the top, we see revenues. Down below, we see expenses. And the resulting figure is going to be any net income or loss. And here we have net income over a period of time. So I'm looking at quarterly data right now. Or actually, I'm looking at annual data. So this is going to tell me that in the year ending, fiscal year ending September 24th, 2016, these were the revenues that were earned. These were the expenses that were paid out and the resulting net income. So we talk about how it's comparable. Well, I have the going assumption that in 2016, 15, and 14, Apple adhered to GAAP when it produced this report. So when I come down here, I can see where 16, 15, and 14, right here, 16, 15, and 14, I see changes to net income. Hey, I know that they use the same accounting rules to get down to this number. So it makes me question, I might question, why did we have an increase and now a decrease? Your statement of cash flows. All right, period ending. So again, annual data. This is the end of their fiscal year. And all cash coming in by operating activities, by investing activities, and changes in cash due to financing activities. again, over a period of time. Here we have the balance sheet. Now, again, we notice it doesn't say period of time, it says period ending. And we have the assets, liabilities, and the owner's equity. I'll point out real quick on the balance sheet, when you see the word current assets, what time period? When I say current, what time period am I referring to? 1 year. All right, so these are the assets that I expect to use within a 1-year period. And we see that they're listed on this balance sheet in orders of liquidity. When I talk about liquidity, I'm talking about how quickly can it be converted to cash. Well, cash is already up at the top, all the way down to property, plant, and equipment. It would be hard for Apple to go out and sell. It would not be very quick that they could go out and sell their headquarters. Current liabilities. Okay, when I see the word current liabilities, these are obligations that I expect to come due within 1 year or less. And again, they are listed within the date that whatever I expect to pay first. So again, accounts payable. These are going to be my everything from salaries and wages to my vendors. Short-term debt. Notice how it's listed above long-term debt. So again, these are listed in order that they are due. And because Apple is publicly traded, we know that we can find that data, and you can find the data of other companies. Again, when you went out, those that are publicly traded, you'll be able to find data on them as well. All right, the last bit that I will end on. Yeah. All right, on a global view, we talked about GAAP. Now let's look at some of the differences between GAAP and the International Financial Reporting Board. Both include broad and similar guidance for accounting. Both are going to set out to achieve the same objectives. Primary objective being oversight of the accounting standards. Okay, neither specifies particular account names nor the detail required. I'm going to show you that the International Financial Board does require reporting a certain minimum line and other minimum disclosures that GAAP does not. There'll be a little heightened bit of disclosure there. GAAP requires disclosure for the current and prior 2 years for the income statement, statement of cash flows, and statements of retained earnings. And the International Board, how long are they going to require? Disclosures for the current and prior year. All right, I'm going to say GAAP is sometimes considered more rules-based, whereas the International Financial Board is more principle-based. GAAP is going to be more focused on strictly following the accounting rules. The International Financial Board is going to be concerned on how to follow the accounting principles. So think of it, GAAP is more, it's more objectified to adhere to the rules. International Board is going to be more of following the principles of accounting. And both U.S. GAAP and the International Financial Standards Board are going to produce the same financial statements. So these 4 statements that we have on the board, both are going to require that they be used. Both are going to interpret the same. There's just going to be a little slight differences. The book gives you a good example if you follow of a company such as Samsung. Okay, Samsung, again, being an international firm that's based but having a strong presence here in the United States. And when you have a company such as this, when they report their numbers inside the United States, they are going to have to convert those over to GAAP. If they're reporting them to the American user, they're going to have to follow the American accounting principles, and that being GAAP. If you look at the global view, the text will give you a status of the world and kind of show you how far this International Financial Reporting Board encompasses. And we are nearly out of time, but I have 6 minutes to throw one last ratio up. What ratio is ended in this chapter? The return on what?
Assets.
The return on assets. All right, does everyone feel comfortable computing by plugging in the formula? Net income divided by average total assets. Net income divided by average total assets. So net income divided by average total assets. All right, so remember, where would you get this number from?
Annual income statement.
The income statement. Doesn't necessarily have to be the annual, let's just say the income statement. Where am I going to get the average total assets?
They come off that statement too.
No.
Beginning and ending amounts for the same period divided by 2.
But which statement am I getting them off of?
The income statement.
Which statement has that accounting? Remember, assets equal liabilities plus owner's equity. The balance sheet. So I'll get this number off the income statement. I'll get average total assets off of the balance sheet. And finally, what does return on assets tell me? In my words, how efficiently a company is utilizing its assets. Okay, again, what's our objective? To earn a profit. Our true objective is to maximize profit. If we really want to say what is the chief objective of a company, it is to maximize profit. Well, let's not just stop short of earning, let's maximize. So how effectively am I taking the assets that I own, and how effectively am I earning a profit? Now notice if that changes to net, if net income is 0 or less than 0, we're going to come up with some negative number here. That's going to tell me I'm doing a poor job. But again, how effectively am I achieving my chief objective with the assets that I own? All right.